It's no news that the popularity of passive investing is on the rise. Take a look at the chart on your screen. It shows the assets of passive funds, ETFs, index funds, and fund of funds or FOFs. At the end of 2018, the assets of passive funds stood at 1.22 lakh crore. By 2022 end, they grew to 6.36 lakh crore, a jump of over 400% in just 5 years. Now, there are many reasons responsible for the rise of passives, including their low cost, low maintenance, and wider suitability. But one reason that stands out is their active counterparts underperformance. A look at the percentage of funds underperforming the Nifty 100, Nifty Mid Cap 150, and Nifty Small Cap 250 indices will give you an idea. Now, as you can see, in 2022, nearly 67% of active large cap funds underperformed the Nifty 100. For mid caps, percentage of funds underperforming was 55%. And even though just 13% of small cap funds didn't beat the benchmark in 2022, this number was quite high in the preceding 2 years. So underperformance by active funds possibly significantly boosted passive funds. Hello and welcome to the ETMONEY channel. Today we'll discuss which is a better avenue for investing passively, ETFs or index funds. But before we start, do subscribe to our channel and do click on the bell icon so you never miss a video from us. Now in this video, we will discuss key parameters you can use to evaluate ETFs and index funds, and also evaluate some of the most popular ones to see what comes out on top. So even if you know the nuances of investing in ETFs and index funds, the in-depth analysis in this video will give you some more useful insights. Alright, let's start with a quick recap of difference between ETFs and index funds. ETFs and index funds are the two main avenues of passive investing. Now another emerging option is fund of funds or FOFs. An FOF puts money in another fund which could be active or passive. There could be even multiple underlying funds of an FOF. However, from the perspective of how you invest, FOFs and index funds are similar. You can invest in both as you would invest in any other mutual fund. So mainly we will talk about differences between index funds and ETFs. Look at the table on your screen. It mentions the key differences between the two. We also have a video about the differences between index funds and ETFs. So if you want to understand the differences in greater detail, you can find its link in the description of this video. Now, broadly, the difference between index funds and ETFs lies in the fact that index funds can be bought and sold like any other mutual fund. But for ETFs, you will require a demat and a trading account, and you buy and sell them the way you buy and sell stocks. Now, ETFs and index funds track an underlying index, so they are similar here. So what is a better option? Let's try figuring that out. There are about 160 ETFs, 88 index funds, and 124 FOFs available. So it's nearly impossible to compare them all, and hence, for our analysis, we will focus on the index funds and ETFs based on the Nifty 50 index. You can use the framework we will discuss to compare any other ETF index fund you want. We will look at factors that impact the performance of an index fund or an ETF. These include expense ratio, tracking error, the purchase price of ETFs, and their liquidity. So let's start. The first criteria is the expense ratio. As we discussed earlier, one of the reasons for popularity of passive investing is that the expenses are quite low. So how do Nifty 50 ETFs and index funds compare in terms of expense? For this, we looked at the maximum, minimum, and average expenses charged. As you can see, ETFs have a clear edge. They have average expenses of just 0.07% as against index funds 0.22%. Now, ETFs look like a no-brainer when it comes to expense ratio, but there are trading costs associated with ETF investing that you need to keep in mind. For example, on buying and selling 1 lakh worth of ETFs, you will have to pay 239 rupees as fees and duties. That's around 0.24% additional cost. Now this is without brokerage charges. So depending upon your plan, there will be additional costs. Now when we were researching for this video, we came across an interesting trend. Until around 2015, the average expense ratio on ETFs was about 60 to 70 basis points. Over the years, it has come down drastically. We saw a similar trend in the average expense ratio of index funds. This is an excellent news for investors, and it is happening because of the rising competition in this space. As more investors flock to passive investing, more AMCs have launched ETFs and index funds. Alright, now let's talk about the next parameter, tracking error. So as we discussed earlier, an index fund or an ETF tracks an index. So you would want a fund that exactly replicates the index. If a fund falls or rises more than the index, it destroys the purpose of investing in an index. Now, how well the fund has replicated the index can be measured through a parameter called tracking error. If the fund behaves just like the index, the tracking error will be low. If a scheme is not doing a good job, the tracking error will be high. So the lower the tracking error, the better. The chart on your screen compares the tracking errors of Nifty 50 ETFs and index funds. ETFs have lower tracking error on average, which suggests they do a better job of tracking the Nifty 50 index. Now, there are few things that lead to tracking error, but mainly there are three big reasons. Let's understand them one by one. Now, we see the index change with time. Companies are regularly excluded from the index and replicated with another one. Then there are events like HDFC Limited and HDFC Bank merger. The two companies became one. Consequently, the weight of HDFC Bank was changed in the index. Now, scheme tracking the Nifty 50 index have to make all these changes. Now, if they manage these changes well, the tracking error will be lower. However, if for some reason a fund takes time to implement these changes, the tracking error could be higher. The second reason is cash. A fund keeps a small portion of money in debt instruments. They do this to manage inflows and outflows. Inflows mean new investments that come into the fund, and outflows mean paying those investors who have put redemption requests. This cash also results in tracking errors. If not managed well, this can result in a higher tracking error. But ETFs have no requirement to manage inflows and outflows. You just buy ETFs from the stock market and the fund house is not involved in this process. So ETFs themselves do not have to maintain any cash. Take a look at this table. It shows the average 5-year cash holding of index funds and that of ETFs. For index funds, it ranges from 0.19% to 5.25% of the total assets. For ETFs, it's between 0.01% and 1.22%. Tracking error is the most important parameter to look at when you are choosing an index fund or an ETF. But investors are interested in returns. So let's look at the difference in returns between ETFs and index funds. Now, if all schemes track an index, their returns should be similar, but that's not the case. Expenses and tracking efficiency differ for each scheme, and the two parameters directly affect your returns. While it's true that the difference would be small, but over long periods, even such minor differences can significantly impact your final corpus. So on your screen, you can see how Nifty 50 ETFs and index fund compare in terms of returns. Here also, ETFs do well. Against an average 5-year return of 13.53% from Nifty 50 ETF, Nifty 50 index funds deliver 13.23%. So given the ETF returns are better, they have a lower tracking error and expense ratio, they may look like a better option over index funds. However, the story isn't over yet. With ETFs, there are another two important determinants, the price to NAV gap and the liquidity. Let's understand these two metrics as well. As ETFs trade in market, demand and supply often control their prices. This often results in their prices deviating from their NAVs. This means the ETF's price could be higher or lower than its NAV. Now, if the price is higher, you're actually paying more than what the ETF is worth. And if the price is lower, you're getting the ETF cheap. But how big is this difference? Let's take an example to help understand this. We looked at the SBI Nifty 50 ETF, the largest ETF on the Indian exchanges. It has assets of about 1.62 lakh crores as of June 2023. Now, until about October 2022, this ETF had a price greater than its NAV. So if someone invested in it around that time, they would have bought it expensive. However, after that, the price has been at a discount. So you're getting this ETF cheaper than what it is worth. So is it a great thing? Well, it depends. If the price always remains at a discount, it may not be a problem. And by the same logic, if the price always remains at a premium, it may not be a problem. The problem will come if this price or discount is significant. The worst thing that can happen is that you buy an ETF at a premium and now it is selling at a discount. Hence, you must assess the price NAV gap of an ETF before you buy it. If the price is at the premium to the NAV, it's better to wait or simply buy any other ETF tracking the same index. You can very much buy an index fund as well. Now, because index funds don't trade in the market, they don't face this issue. This is where they have an edge over ETFs. Okay, what if you want to buy an ETF and you want to know its NAV at that point? Now, NAV is reported at day end, so all you will have is the previous day's NAV, which may not be the best guide if the index has moved significantly. So what do you do then? Thankfully, SEBI has you covered. SEBI has instructed fund houses to publish INAV or intraday NAV for ETFs. This INAV can tell you what the actual worth of one unit of an ETF is. You can find the INAV both on the exchange and the AMC website. See the screenshots on your screen. These show you the INAV of SBI Nifty 50 ETF on the NSE website and that of SBI Mutual Fund. Now see the table on your screen. It shows the average 1-year premium and discount to NAV of the available ETFs. It also shows the maximum discount or premium that a particular ETF showcased. Some outlier values have been highlighted. Given that the deviations could be really steep, do make sure you check the price NAV gap before you buy an ETF. Let's now move to the next parameter, liquidity. Now in the stock market, liquidity means how easy it is to buy or sell a stock or an ETF. The higher the liquidity, the easier buying and selling an ETF is. Now, liquidity is not an issue with index funds as the fund house has to honor the buy and sell orders with the index funds. So with index funds, you place a buy order with the fund house and units are allotted to you. You place a redemption request, the units are redeemed and the amount is transferred to your account. But with ETFs, you must be mindful of liquidity. If you somehow end up with buying a low liquidity ETF, you may find it challenging to sell it as there may not be corresponding buy orders at that moment. To assess liquidity, we use a metric called volume. Now, volume is the number of units of a stock or ETF that is traded in a period, or it can be the value of those units. Take a look at the table on your screen. It mentions the available Nifty 50 ETFs and their average volume in rupees. From about 62 crores in a day to just 80,000, the liquidity of Nifty 50 ETFs varies widely. So if you want to invest 1 lakh in Invesco Nifty 50 ETF, which has a volume of about 80,000, it'll be difficult. Similarly, selling 1 lakh worth of ETFs would be difficult. But if you want to buy the Nifty 50 ETF of Nippon India, it's no problem at all. The order will go through like a breeze. Another related point, the less the liquidity, the more the gap between the price and NAV of an ETF could be. Why? Because a less liquid ETF can show wild moves in price depending upon the order size. The same thing happens with less liquid stocks. If a large buy order is placed for such stocks, their prices skyrocket. If a large sell order comes, the price can tank. So while buying ETFs, be very careful about the liquidity. Here we talked about just the Nifty 50 ETFs. They are expected to be the most liquid. Now there are plethora of other ETFs as well. There are sectoral ETFs, factor ETFs, thematic ETFs and so on. And many of them have very thin volumes. Now, as discussed earlier, index funds don't have such issues. So while ETFs have an edge based on expenses, returns and tracking error, the situation gets complicated when the price NAV gap and the liquidity troubles come into the picture. So what should you choose, ETFs or index funds? Let's see. So ETFs or index funds? I think the question itself is wrong. Let me rephrase it. What do you like better? Did you say ETFs? You're right. Did you say index funds? You are right too. So there is no right or wrong answer to this question. It depends on you as an investor. Suppose you are comfortable operating a demat and a trading account and you can assess ETFs for their price NAV gap and liquidity. In that case, ETFs can save you money and get better returns than corresponding index funds. However, if you want to keep it simple, index funds are the best way to go. As we suggested in the video on the differences between ETFs and index funds, you can even see them from the standpoint of investment horizon. Index funds provide the SIP facility and are more suitable for long-term investors. ETFs provide buying and selling during market hours and can be useful as tactical bets. But this is not to suggest that ETFs can't act as long-term investment instruments. You can do manual SIPs in them, and today many brokers provide the SIP option as well on stocks and ETFs. So pick whatever suits your requirements better. Now, whether you pick ETFs or index funds, invest regularly and keep a long-term horizon. And with this, we have come to the end of the video. If you liked it, don't forget to share it with your friends and family. And I'll see you again soon with another insightful video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.